Ever notice how price suddenly reacts at a certain zone on your Forex chart? These aren't accidents. They are called point of interest or POIs, and smart money traders use them to stay on one step ahead. Let's break it down. What is a point of interest? A point of interest is a specific zone on the chart where we expect price to react from. It could be a reversal area, a breakout zone, or where institutional traders previously enter a massive position. These zones often mark previous high and lows, strong candles, or on-field imbalance in the market. In short, POIs are hotspots for the market. Why POIs matters? POIs help us trade with intentions, not impulse. You are not guessing anymore, you are planning. And most importantly, you are trading with the big players, not against them. When price return to a POI, it often gives us a high probability setup. That's the smart money at work. Types of POIs that we have. Let's talk about some common type of POIs. Number one, order blocks. These are the last candle before a big move with where the institutional players made their plays. Number two, liquidity zone. Areas above or below recent high and low where retail stop losses are hidden. Number three, supply and demand zone, imbalance price areas where strong move originated. And number four, breakout blocks, broken support or resistance that become the opposite, either a failed supply zone or a failed demand zone. Those are your breakout blocks. These are your key zones to watch out for. What validates a POI? Number one, your POI must have swept a previous high or a previous low. Number two, must have broken structure either to the upside or to the downside. Number three, must have a liquidity above or below it before an impulsive move. Let me show you an example of that, of what validates a POI. Number one, we said your POI must sweep the previous low and give us a break of structure to the upside, then give us a liquidity protecting it before the big move. So this, you can see here, we swept the previous low, we broke structure to the upside. Let's mark this out as a break of structure BOS, and we have here as your liquidity zone. This zone right here, it may be a demand zone, or you can use this other zone right here, a breakout block. This zone right here becomes your POI. So we are expecting price after a sweep of liquidity, a break of structure. We are expecting price to come back into this zone to take out this liquidity and buy from here. So what do? We place our buy limit, stops slightly below this low, and we target this next high. Now for a sell, it's basically the same thing. We wait for a sweep of the previous high, a break of structure, a liquidity, another break, then we wait for price to retrace back into our supply zone before the impulsive move. Our sweep of liquidity, our break of structure, our liquidity zone, then our supply zone. So we set our limit order, target the next high. Now, make sure and note that price must have swept the previous high and broken structure to the upside. This guarantees that this high here is going to hold. What that means is that price is not going to take this high out. So your POI, to what validates your POI, what makes your POI solid is that it must have swept liquidity, given an inducement, which an inducement liquidity. Those two criteria must be met, and it must have broken structure either to the downside or broken structure here to the upside. So this is what validates your POIs. So how do we use POIs? First, you identify the current market structure. Identify the current market structure. Step 2, wait for a price to sweep a previous low or a previous high, then giving you a break of structure, your liquidity. Then you mark out an area of imbalance or a demand zone closest to your liquidity. Then you wait for price to pull back, then you set your limit order or your buy order, then you buy. Let me show you a chart example of that. You can clearly see in this chart that price is in a downtrend. How do we know that? Because price is breaking structure to the downside. So what did we say? Price must have swept a previous high or a low. In this case, you can see this spot here. Price swept this high and it broke structure to the downside. Let's make it a break of structure. And it also broke this swing low. Then price gave us a liquidity, which means this high is protected. Price is not supposed to come back to this high. And how do we choose our POI? A supply zone. In this case, this zone here. We pick out this zone. Price has already met our criteria: a sweep of the previous high, a break of structure to the downside, a liquidity, then a supply zone. What do? We set our limit order here, start above this high. And where do we target? The next high. In this case, you target this high, this low, sorry. That's it. Your TP hit a 1-to-6 risk to reward ratio. Now for a buy, we basically look for the same thing. You can clearly see price was in a downtrend, breaking structure to the downside. But what did price later do? Price broke structure to the upside. You can clearly see here. Price broke structure to the upside and also gave us a break of structure here. And how do we choose our POI? You can clearly see this low right here was swept. This is our second criteria. Why? Price swept this low and price gave us a break of structure. You can use this candlestick as your liquidity. Then you pick this area as your breaker block. Use it as your POI, as your entry. Set your limit above here and stops below this low. Remember, we are expecting this low to be protected. Why? Because price swept this low, broke structure to the upside, give us a liquidity. So this low is expected to be protected. Price is not expected to come back here. So we target the next high. So what did that price do? Price came, tapped into our POI, then bust to the upside. So what are the common mistakes traders make in picking the POIs? Here are some common mistakes traders make with POIs. Forcing trade at every zone. Not every POI is valid. Remember, we said what validates a POI must have swept a previous low and given us a break of structure either to the upside or to the downside, and there must be a liquidity above it or below it. This is what validates the POI. And number two, ignoring higher time frame confluence. A lot of traders just go straight to the 5 minutes to the 1 minute. No, you must have a clear directional bias from a higher time frame. We'll be covering that on more videos to come. How to use higher time frame alongside with lower time frame. Number three, skipping confirmation, jumping to trade too early are some common mistakes traders make. Number four, clustering the chart with too many levels, marking out too many levels. You can see we only picked out few levels here, even with the example that we were given that we saw here. We didn't have a lot of markings. We only marked out our sweep of liquidity, our structure, our inducement, our POI, and our break of structure. That was it. Just following basic market structure and following the confluences that align with our entry model. It's quality over quantity. Points of interest are powerful tools. When used right, they keep you patient, they keep you precise, and they help you think like a pro. If you found this helpful, give us a like, subscribe for more Forex tips, and drop a comment below. Thank you for watching. See you on the next one.